Hi, Alex.
Yimin, hey, welcome everyone who's joining our webinar today. So we're running live. As always, this will be available on YouTube later on. So it's Alex King here. I'm the CEO at Sestrian Capital Research. We're an SEC-regulated independent equity research business. We've been delighted in recent years to have Yimin do a whole bunch of macro work for us in the macro musings notes that he does for us. Terrific work through a very volatile macro environment where the Fed has dragged markets this way and that way in the usual way, but even more so given the big gyrations in monetary policy. One of the things that I personally have found is that everyone on FinTwit has become a Federal Reserve expert in the last few years, or at least they think they're an expert and often don't know very much at all. Yimin's great talent is that one, he does know what he's talking about, and two, that's because he has a background as a professional rates trader, which he's going to tell us all about. So, Yimin, maybe you could just do a minute or two for those who don't know you here, just to introduce yourself and your background and why you started, writing and publishing this research.
Yeah, no problem. Thank you, Alex. Thank you everyone for joining this webinar. Last time we delivered this was about 10 months ago, March last year. So it's a really good time actually before the FOMC tomorrow to give a refresher. I'm going to cover some of the basics like I did last year, but I'm also going to talk about the current trajectory and what we should expect, not just tomorrow, but for the rest of the year. A bit of a background about myself. So I traded FX swaps and short-term interest rates, which means sub 2 years, the front end of the yield curve at Royal Bank of Scotland in London. And my specialty was focusing on US and Canadian interest rates, but I also covered for Australia, New Zealand, and Japan. And since 2022, I've been covering the FOMC press conference on Seeking Alpha News. You might have seen my comments there. And actually, we've together, Alex and I have worked together for over 3 years now, and we've made some great learnings along the way and great calls as well. So just last year in July, we were the first research house out there to come out and say the Fed is done. We may not actually see another hike again. And this is not due to this is actually just down to the simple understanding of how the Fed operates, how they approach data, how they think about their decisions. And I think it's really important that today we're not making bold predictions to be 100% accurate about the future. No one can do that. But I really would like you to walk away with some understanding of how the framework we use to understand the Fed and how the Fed thinks about the economy, the interest rate curve, the markets. And I'm sure you'll have loads of questions. We'll have a ton of content to cover today. So let's begin. I'm going to turn
great.
off the camera. Yeah.
Thanks for the introduction, Yimin. That's fantastic. And as regards the work together, well, I can tell you as regards Fed matters, I've learned a lot and you've made a lot of great calls. So congratulations. And I shall hand over to you now just to walk through your presentation, which is, folks, to remind you all about how to learn to speak Fed. Yimin, take it away.
Okay, thank you. So just a simple overview of the Fed structure. So the Fed Reserve, which is chaired by Jerome Powell, has a board of governors. And the board of governors are appointed by the president nominated by the president and then confirmed by the Senate. But at the same time, underneath that federal structure, there are also regional reserve banks that you might hear. Sometimes the president of the reserve banks come and speak in the press. And so their responsibility is for their region in terms of the managing and supervising the member banks in the region. So there are 8 FOMC meetings per year. Each meeting is live. What that means is that they could make an interest rate decision on any of those meetings. Typically, we see 25 basis point moves if they do make a decision, but sometimes they have done 50 or 75 basis points. But that is more unusual. So typically, we expect 25 basis points. And the setup is that there are 12 voting members. So 7 voting members come from the board of the governors, the ones being appointed by the Senate. But the other 5 come from the regional Federal Reserve banks, and they are done in a rotational basis. except for the Bank of New York. So the president of the Bank of New York will always be a voting member, and the other four will rotate each year. To ensure independence, the board of governors, once they're appointed, they can run for 14 years. They have a 14-year tenure. What this means is that no one can fire them, but also after 14 years, they won't be reappointed again, just in case they gather too much power. The slight difference is that the Reserve Bank presidents are appointed locally and they run 5-year terms, and then they rotate once every 3 years into the voting seat. So for them, the influence is a bit smaller, but they still have, but they can be reappointed. So they can actually stay as the president for a long time. So that's kind of how they ensure the separation and independence piece. The two key mandates that the Fed holds, and they hold them simultaneously. First is maximum employment, and the secondly is the price stability. So actually, maximum employment doesn't have a specific definition, as it were. There isn't like a specific number we put on how employed the US needs to be. The notion is that if you want a job, you can get one, and that is maximum employment. And this is, and sometimes we can see there are more jobs being added to the employment pool, but actually unemployment rate goes up. That's because more people are entering the workforce, i.e. the participation, than people who have found a job. So the unemployment level really depends on how many people are looking for a job and whether they can get one. So from December, we actually had a quite hot set of data. The January data will come out later this week. But in December last year, 216,000 jobs were added, which meant an unemployment rate of 3.7%. So this is actually really tight. I think the historical low in the past 30 years was 3.4%. So after 5% of rate hikes, the labor market is still really tight. And this is kind of down to a few reasons. Some are structural. There's less immigration since COVID. So there is a shortage of labor. But also the productivity has gone up as well. The GDP has been soaring. So there are more jobs available. And you can see from the earnings as well, like the earning numbers have also been quite hot. It grew 4.1% year on year. The difficult part about the earnings is that if the earning is too hot and is actually due to the inflationary pressure from, for example, that the companies cannot pass on into productivity, there's a knock-on effect on the overall inflation, especially in the services sector. So this is something we need to watch quite closely. And we want everyone to earn a nicer salary, but sometimes if it's too hot, we can have a knock-on effect on the overall inflation. So the second piece of the Fed mandate is price stability. So formally, the Fed tracks PCE, personal consumption and expenditure, as opposed to CPI. I will explain a bit more later, but they're targeting a 2% inflation. And since 2021, I believe, they've been broadening that range to 2 to 2.5%, so not fixated on a single number. But it's really important that they get inflation down to that range. And the reason is that range is important is that if the inflation is too high, then businesses cannot price set effectively for the future. They don't know whether prices will head towards, and they can't, employ people effectively and know how much they should produce and what price they should raise later. Economy can get into a mess. But on the other side, if the inflation is too low, which was actually the case since 2008, the problem is that people then don't want to spend, because if the price is not moving anywhere, and actually in Japan, prices were decreasing for a while, your money is worth more tomorrow than today. So it's better off that you don't spend the money and just wait for prices to drop. If that happens, then the economy wouldn't grow. So you want a balanced situation where the prices are rising at a steady rate, but not too hot, also not too cold. So a common question is, where does the 2% come from? Actually, 2% is a number that sort of is not really a scientifically backed number, surprisingly. It wasn't a number that came from academic research. What happened was that in the 1980s in New Zealand, inflation was really high and they had to do something. It was something like 15 to 20%. And when the finance minister of New Zealand was asked, like, so what's your target? Um, the finance minister literally just said, I think 1% is reasonable, right? Because it's growth, but it's not extremely high. So what happened was that the New Zealand central bank decided, actually, we need to do a lot to back this number now. We're like kind of tied to this. And what he said was that actually there's always a 1% error rate in the way we measure inflation. So if we're targeting 1% inflation, we might as well make it 2, just in case it goes too low. So there you have it. So it's the number that everyone is kind of fixated on is actually just coming from an offhand comment in New Zealand, and that's had a huge impact on the rest of the world, and especially today. So why do we have CPI versus the PCE? So CPI is a number that comes out slightly early in the month. It measures only the urban inflation. So rent is a big component, goods and services in the urban area. So the Fed feels that it could be a bit too skewed. And basically, the differences are that the PCE measures across urban and suburban household price inflation, and the components that go into it, the calculations have different weightings. What we have seen is that PCE is consistently lower than CPI in the past couple of years, which does make the Fed's job easier as they are going for the 2% number. So the three components of inflation, 25% of inflation comes from the goods, services, stuff we buy in the shops. Another 25% comes from housing-related services, which is rent. So together they make about actually just shy of 50%. The Fed is fairly confident that the housing-related services are coming down because of high interest rate. Mortgage rate goes up, less people are buying houses, and housing prices start to adjust downwards. Rent as a yield on the housing price will also fall. The part that's been really sticky is the non-housing related services. This could be medical services, travel, etc. And this is basically tied towards the cost of human labor. And as we saw from previous slide, that hourly earnings have been quite hot in the past few months. So if the earnings been hot and the price is being passed down into the services prices, what we get is a sticky inflation in this segment. But the Fed has been feeling quite comfortable more recently about this, so they're not as worried anymore, and we'll talk more about this later. But this is roughly how they break down the inflation piece. So December 2023, PCE headline was 2.6. What they really care about is the non-volatile elements, which is the inflation except for food and energy, which is called core inflation. So that's 2.9% year on year. So that's coming down nicely from 5% a year ago, now like 3.2% at the month before, and now 2.9%. And if you actually look at the overall picture, the goods element, the top 25% of PCE is actually now in a kind of like this inflationary territory. It's not really the price is not going up any further, and the services inflation have also slowed down. So this part from 4.1% to 3.9%, which is why the Fed is gaining comfort. The 3-month and 6-month core PCE annualized actually have annualized below 2%. So if you take last 3 months inflation and just extrapolate for the whole year, we're getting sub 2%, which is more than meeting the target. So tomorrow we're going to have our first FOMC of this year. While it's true that in any meeting a decision can be made on whether to raise interest rates or not, March, June, September, December's are more important than the other 4 meetings. This is because with those meetings, you can get a summary of economic projections from the Fed. And with the inside the projections, you can see what the Fed thinks about future inflation in the next couple of years, GDP, and also where they feel inflation might be headed. And so actually, just going back, so among those 12 voting members, I've only put the voting members on here for 2024. Some people are more leaning towards towards a hawkish stance. What that means is they like interest rates to be high and the financial conditions to be tight, and they prefer it just in case inflation shoots back up. There will be some members who are more dovish, and they feel like inflation is the job is done, and we might get a recession if we're raising rates too much or staying too high for too long. So they're roughly split into 3 camps: doves, centralists, and hawks. So we can see most members are centralist, and there's a couple of doves and 3 hawks there. Kugler is new to and I think she hasn't made any comments yet, so we don't really know where she leans. The reason this is important is that you will see Fed speak on Bloomberg News or Reuters throughout the year. And someone would say, Barkin, for example, would say, oh, I think we should stay higher for longer, for example. But that's his natural tendency to say that. What you should really start watching is if those people, Powell, Williams, and Jefferson, start moving towards a more dovish stance, and Bowman, Mester, and Barkin are not as hawkish as they used to be, you're looking for those shifts in tonality from those people to see where the Fed is leaning collectively in the next year. So it's actually quite interesting and to track who's saying what over time, given their natural tendencies. It's a bit like playing poker, and if a card player is going out playing a lot of hands, maybe they've changed style or something is happening. So what do people discuss in the FOMC? The most important thing is they make a decision on where the Fed funds rates should be. So the Fed funds market, I'm going to try to keep this quite on a high level. So the Fed funds market is where the banks are trading their bank reserves with each other, and it's an overnight rate. So currently it's 5.3%, around that mark. And what the Fed does is they will say our target rate will be between 5.25 and 5.5%. They won't give you a specific number, but they will give you a range. What they can do is that if they felt the overnight rates are trading outside of this range, or where they want it to be too much, they can always pay banks, and they do pay banks on their reserve balances directly, and this is called interest rate on reserve balances. So if banks are receiving, let's say, 5.3% from the Fed, they have no incentive to lend out at a worse rate, essentially. And the Fed does the same thing with money market funds in overnight reverse repo market. So if the Fed has a few ways of influencing the target rate to indirectly affect the Fed funds market. And what the Fed also does is that in major meetings, the 4 meetings I mentioned before, they will show a dot plot. They will show the projection of where they think the rates could be going next year and the year after. At the same time, we actually have a live market called the Fed funds futures in the bond market out to 2 years. And it's incredibly simple. So you can see this 95.235 here. All it means is the yield is 100 minus this price. So it's 4.75% interest rate expected for July this year, right? And it's a monthly contract. So using all of this contract, you can actually project where the market thinks the Fed funds rates are going to be. And the math is really simple. It's just the average for each month. It's just the average expected Fed fund rate for that month across the 30 days or 31 days. So if we look at where the market is now, what we see is that the market expects 5 to 7 cuts in 2024 this year. March is not a done deal yet. So it's about 50 to 60% chance that the Fed will go in March. That's what the market believes. This is not what the Fed has said, but this is what the market believes. And the market sees 4 consecutive cuts from May onwards, and then 1 cut every other meeting. And I will talk more about this because we're in an election year. So we'll talk more about the different scenarios that can play out later in the year. But this is the basic expectation. The market expects 5 to 7 cuts for this year, and then 2 more cuts next year. And this is what it looks like in the graph. And the reason this is not a 25% drop is the market is pricing 13 basis points. It just means it believes there's a 50% chance that the Fed will hike 25 basis point, not that the Fed would actually do 12.5% basis point cut. And if you can contrast this with the Fed dot plot, the dot plot says we're going to cut 3 times this year to 75 basis point, and the market doesn't think that's enough. The market thinks there will be at least 5 to 7 cuts this year. So why does the market think that? And why does the market think the Fed is going to cut as soon as March? It seems a little aggressive on the surface, but if you look at the history of the Fed decisions, the Fed rarely stayed at the peak interest rate level for more than a year. I think the last time we stayed for a year, it was just before the great financial crisis in 2007 actually. And in 2019, we had the trade war and Powell started cutting quite quickly, and we had the dot-com bubble in the early 2000s. So the history basically says the median of the Fed staying on the peak rate is 8 months. March would be the 8th or 9th month since the last rate hike. So it is about time for the Fed to take off some of the rates. But at the same time, it might not be the wise decision to do, because we saw that the PCE is now coming down nicely to 2%. But if you look back into the 1970s, what we had was that the Fed, we had really high inflation, which is the red line here, the PCE. The Fed raised rates aggressively, thought the job is done, took it off back to below 5%, and the inflation only came back stronger. And the Fed had to raise rates again, and it just yo-yoed to a higher and higher rate each time. So the history also suggests that maybe it could be too soon if we have a repeat of the 1970s and 80s, which is not really fun for anyone. But then on the other side, if we look at the real interest rate of where we are, we're now up around. So PCE is at 2.9%, the core PCE 2.9%, and we have an interest rate of 5.3%. So the real interest rate is 2.5% now already, and that is a bit too high. Is that right? Is it? Yeah. So that looks a little bit too high. And from research of the different regional Feds have done different research around where the neutral rate is. Research shows that the neutral rate should be the real neutral rate should be 1 to 1.5%. What that means is that if inflation is going to be 2% exactly, we should have a nominal interest rate of 3 to 3.5%, which is where we're talking about 2% below the current level. So it kind of justifies a 2% rate cuts between this year and next year to get to a neutral rate, which is where the economy was grow quite steadily without any trouble. So this is kind of like, so this is all the different forces that we're dealing with, the historical force, the theoretical neutral rate, and the immediate data set we are getting from non-farm payrolls and PCE. If you're confused, that's perfect, because that's exactly how the Fed feels right now, and that's how investors feel. There isn't a right answer. That's why a lot of this is guesstimate. That's why the Fed gets it wrong a lot of the time. They thought inflation was transitory 2 years ago. It wasn't. Now they're looking to cut. They could be cutting too early, or if they don't, the recession could be coming around. Who knows? But we need to figure out the framework of how they approach the situation to understand what they're going to do next. So a little bit on the yield curve. We'll keep this really simple. If the yield is going up, the longer into the future is called a normal yield curve. If the yield is coming down, the longer we're going to the future, it's called an inverted curve. If the rate stays the same, it's called a flat curve.
Yimin, it's Alex here. I'm going to have a
Yeah.
stupid question for you, which is, my background is equities, not bonds, right? So I always get myself backwards when it comes to yield and bond prices. So just remind everyone, what does yield up mean for bond prices, and what does yield down mean for bond
Yeah.
prices?
Yeah, that's a really good question. So yield is the inverse of the bond price. So if the bond price goes up, that means the yield is going down. So what this means is that the 1-year bond price is for this normal curve is at a lower price than the 30-year bond price. Just because of how the math works. And what you often see is that people are saying the bonds are rallying. When they say bonds are rallying, it doesn't mean it actually means yields are coming down and the bond prices are going up. So this is a really important distinction. And bond traders would always talk about the bond price in terms of movement. They will never say the yields is rallying. Every time they say rally or every time they say there is a rally, it always means the yield's coming down and bond price is going up.
So if the yield is coming down, you're basically getting paid less to take risk, and therefore,
Yeah, that's right. Yeah,
okay, got it.
you're
And
paying a lower price for the. Sorry, if the yield is coming down, you're paying a higher price on the bond on holding the bond.
that's right.
Yeah, that's right. Yeah.
Okay.
Yeah. So this is the yield curve today using the U.S. Treasuries, and you won't see this yield curve elsewhere because this is a forward curve. So if we're talking about borrowings, if we're borrowing for 1 year in 15 years time, this is where the yield would be 4.5%. So the yield curve is almost like U-shaped. We're expecting interest rate cuts, but 5 years and 10 years out, we're expecting the interest rate to come back up again. And this really shows confidence that inflation will stay at least 2% in the foreseeable future. Because if inflation is low, then you would normally have a lower interest rate to adjust for the low inflation. Yeah. And the reason I've given you the whole shebang about the yield curve is this. At the moment, we've had a very long curve inversion between the longer term yield, like for example, the 10-year bond rate, versus the front end. So here on the screen, you can see 10-year bond yield less the 3-month bill rate is below zero. So when the gap is below zero, it means we expect rate cuts in the future, and the 10-year bond rate is lower than the 3-month bill rate. But this typically happens when the market expects a recession, right? So in the past 6 months, all we've been hearing is that we're going to have a soft landing, economy is doing really strong, but the bond market is actually still kind of pricing a recession. If you look at the past, right, we had yield curve inversion just below this zero line 3 times before now. First time dot-com bubble 2000, and we had a prediction of 50% recession. This is by the New York Fed, by the way. Second time, 2007, the yield curve inversed. We had another recession, and then the last time it was 2019. It was during the trade war, and we had another recession, right? So every time the yields inverted, we had a recession. So again, this is another factor we have to think about when we're thinking about the rate cuts. If we stay on the same course for so long and not cut the rate early enough, we might risk a recession, which is priced at 70% by the New York Fed, according to this chart. But if we cut too soon, we could risk inflation coming back. So this is a dilemma at hand for the Fed, and it's not an easy option for them to decide.
Yimin, I have a question coming from one of the subscribers here. What are the risk factors for rising inflation in the Fed's mind? Where does the Fed fear that inflation could resurface? Housing, energy, something else?
So in terms of the components, there are things. So that supply and demand side factors. From the supply side, we're talking about energy, like the conflict in the Middle East, shipping bottlenecks, uh, you know, which we had during COVID. These are the things the Fed can't really affect. So whether they raise interest rate or drop the interest rate, cut interest rate, it's not really going to change much about the global conflicts. What they really try to affect is the demand side of demand side equations. So and especially in housing and the services. I think the housing is pretty much under control because that is basically, high interest rate translates to high mortgage rates, which will lead to a housing downturn. That's quite a mechanical thing that is proven and tested. But with services, it's much harder. We've saw hourly earning rising by 4.5%. We have really strong non-farm payrolls because there's too many people. There's a labor shortage in the US, and the economy, the GDP is running really hot. So all of these things from the demand side could push inflation back higher, and that's what the Fed is worrying about. So it's almost like they want to induce not a recession, but like a mild cold to avoid a worse disease almost. So they don't mind the GDP coming down slightly if the inflation doesn't come back. And actually, that's what they're trying to engineer. Um, and yeah, does that make sense, Alex?
It does. That's great. Thank
Yeah,
you.
cool.
I have a follow-up question, then we can move
Yeah,
on,
sure.
which is,
Yeah.
do you have a view on the correlation or any correlation, if there is one, between the current US government deficits and the prevailing rate of inflation? Just your opinion.
So my opinion, so in this webinar, I've actually deliberately left out the debt and US Treasury piece. From my observation from the past year, is that the Treasury, I think if we're in a normal time when the Fed isn't raising rates aggressively and inflation is so high, I think the Treasury piece will have a higher influence on this. But currently, I haven't seen that much of an impact on the Treasury issuances and in terms of debt. And I think it's down to the fact that US it enjoys a very, very special position, which is that as long as the Congress allows the debt ceiling to be removed and the US Treasury can issue unlimited debts, there isn't really a problem in the short term. And it also depends on what they do with the money that comes in. If the so what happens is that if the Treasury issues loads of debt, they recycle the same amount money they raise back into the economy. Nothing really changes. But
Yep.
if they hold the money in, then that's sucking liquidity out of the economy. So they're sitting basically, money in the bank they're not using. That would actually have a, that would actually not be, that would actually reduce the economic activity because there's less liquidity in the economy. Yeah.
Got it.
So that's
Understood.
kind of how I think about it. But I haven't really seen the impact yet, which is why I'm kind of not talking about it in this webinar today.
Got
Um,
it.
um, so, so, so now coming back to, so we've talked about all those different factors that the Fed has to think about, and it can be a bit of a headache. Just to add one more factor into the puzzle, we historically we had a QE since 2008, since the financial crisis. And now we're in QT, quantitative tightening, and QE stands for quantitative easing. And I'll explain what they are first. So QE is the Fed buying treasuries and mortgage-backed securities in the open market. And the Fed doesn't actually print money in terms of actually printing the $100 bills, but it has a similar impact because what they do is they buy the treasuries from banks and the US government, and then in return, they will give banks higher reserves that the banks can then use to lend to other counterparties, invest in risky assets, etc., as long as they're adhering to the regulatory requirement. So the Fed buying those securities from the open market injects liquidity into the markets and the broader economy. It lowers the borrowing cost, and that's why you saw SPACs being listed, 100 SPACs being listed in 2021, and all the risk assets going up, going up. But right now we have quantitative tightening, and the reason I'm talking about this right now is because usually when you want to cut rates, which is actually to loosen the financial conditions, you don't really want to do something that has the opposite effect, because it would be counterproductive. What the Fed has done so far is they are letting the existing Treasury and MBS securities on their account mature in the short end and not replacing them. So every month there will be around 95 billion worth of those securities rolling off the balance sheet. But still, like, it still sucks the reserve and the liquidity out of the money, bank reserves and money market funds. It has been okay because the money market funds parked nearly $2 trillion into the reverse repo facility 2 years ago, and now it's been run down to around 580 billion. So there is still a lot of room to go down, but there will be a point where you can suck too much liquidity out of this, and borrowing costs start to go too high. And if you're cutting rates, you don't really want to do that because it's counterproductive. It has its opposite effect. So going into tomorrow, I would actually expect the Fed to talk about, to be at least to be asked about the plans for QT. They might not make a formal announcement tomorrow, but sure they should make an announcement in March, because if they're looking to cut in March, if they don't cut in March, let's say in May or June, they should still start making a plan to say, okay, we're still going to passively run down the securities we hold, but maybe we'll slow it down. Instead of 95 billion, we'll do 50 billion, something like that, over the next 2 years until the reserves, the total reserves, get to a certain point. And tomorrow they should also be talking about the time. There will be a quiz about the timing of the first cut. I think so far some of the Fed speakers have pushed back on the March. They feel it's too early, but at least tomorrow they should give up the optionality to give. I don't know why we're still talking about this. Are we at the rate peak? Yes, we are. I think they're going to formalize that language tomorrow to give up the optionality to go for another hike, and they will be asked about the timing of the first cut. They will be challenged on whether it's going to be March or May, whether it's too early or too late. Especially given we've had a really hot print in GDP, which is 3.3%. So why are we cutting rates when the economy is going so strong, non-farm payroll is so strong? How much are you accounting for those factors versus the inflation, PCE coming down nicely towards the target? And the final point about QT is that theoretically, what the Fed has done is they've come up with a framework to say, to say that we're happy for the bank reserves and money market funds to have around 10% of GDP, which is around $3 trillion. If we go below that level, maybe we will have issues with funding costs, and we don't want to avoid that like we did in 2019. But currently, we're still 600 to 700 billion dollars away from it, so they're not too worried. So they might just passively run down, do their QT, but maybe at a slower pace into 2025, and then stop there. So I expect those type of questions to be asked and answered in the next 2 meetings at least. And this is the fun part. We are in an election year, and everyone has this question about whether the Fed is biased. So I actually looked into the history of the Fed around the election years. In 1992, when Alan Greenspan was the president, the chairman, and that was I believe that was the election was between George H.W. Bush Senior and Clinton, and Bush Senior lost that election. Alan Greenspan deliberately chose not to hike because they worry that if they did something close to the election date, they will be perceived as biased. And actually, if you look at the past 30 years now, is it 30 years, 40 years now, there had only been one hike, and 3 cuts within 2 months of an election year, in an election year. So actually, I think because if you hike, that is a tightening effect, and the economy can worsen on the back of it, and that could be perceived as bias, whereas the cuts is helping the economy, everyone gets a little bit richer, etc., or their stock portfolio goes up, so people are less likely to complain. And actually, this year is we're in the cutting cycle now, right? So the timing of the cuts will be, everyone's going to have a say about, whether they're being biased, whether they're trying to help Biden with all those cuts. I'm sure Trump will make some sort of comments about that. So the Fed probably has to be a little bit tactical at how they communicate in advance what the strategy is, rather than leaving it last minute. And they have to be quite convincing as well. In terms of the board, the board of governors who were nominated by the president and appointed by the Senate, they're quite balanced. I think it's 3 versus 3 from the Republicans and the Democrats, except for Powell. Powell was appointed by he was appointed as into the board of governors under Obama, but then he was nominated to become the chairman by Trump, and then he was renewed again under Biden. So in terms of the balance, it's pretty balanced. But if we look back into 2019 after Powell was appointed, there were numerous occasions where Trump essentially said, Powell, you should cut more rates, stop doing these little 25 basis point cuts, I need more, to help him, essentially. And there were even discussions that he was thinking about firing Powell. So in the back of Powell's mind, at least, I think, he's going to, if he had to choose one, he might want to avoid Trump just because he had a really difficult relationship with him back in 2019. But, the Fed is meant to be independent, and they have 14-year tenure, and Powell is not meant to step down until 2026, and who can stay on the board for another 2 years. So his position is not going to be threatened by anyone who comes into power again. So it will be all fun and games. This leads to my prediction. Well, my alternative scenarios to the market pricing. So if we look at where the market is now, so 50% chance for March cut, 4 consecutive cuts into September, then alternative cuts in December. I actually feel that December cut where the market is pricing is quite unlikely, just because that's a really sensitive month. The Fed might want to shift it to November, and if they want to slow down, they can always skip the September meeting and do alternatives from September onwards into November cut, and then skip December and do it again in January. And if they really want to be tactical and do nothing for 2 months, they can do the 4 cuts this year and then start doing alternatives from January onwards. But I really think the key is to having to communicate early. They can't just be like, oh, we're data dependent. We'll see what comes next month, because then people are going to be like, oh, are you going to just choose side and see who can win? And the Fed definitely doesn't want that. So coming to the final piece of the webinar. So we've done a lot about bonds, and so why does it matter? What does it mean for equities? Which is what you will be wondering, given we're mostly stock pickers in this service. So, okay, I'm going to talk about theory first, and then we'll talk about practice. The theory is that the higher the bond yield, the higher the risk-free rate, which means investors can always park their money at 5% in treasuries than taking a risk on stocks, for example. So the opportunity costs for the investors are higher. But also, when you do discounted cash flow models on the future free cash flows of the companies that you're picking, the future free cash flows are really sensitive to future interest rates as well. A high future interest rates will discount the future cash flows to a smaller present value, which will then have an impact on the valuation of the company. So that's the theory. So high bond yield is bad news for equities. And mathematically, but also if you think about the financial conditions, high bond yields means tighter financial conditions. Banks are less likely to lend to small businesses, which means there are fewer business that will survive and make growth plans and have decent earnings. But what we have seen is that equity prices and bond yields often have a correlation, but that correlation flips. Sometimes the equities go up with the bond yield. Sometimes it does the opposite. And I think the answers are really nuanced depending on which groups of equities you're looking at as well. We'll walk through 3 groups in this webinar. First, the Magnificent Seven that have done really well in the past year: Amazon, Apple, and the likes of Google and Meta. And if you look at the chart on the right, so when the bond yields, 10-year treasury yields really started ramping up, they initially fell, and then they did a U curve, and they went back up again since beginning of last year, right? And a lot of people missed this uptrend. A lot of people got wrong-footed because they thought, okay, yields going higher, equity will stay down, not good time to invest. But what it ended up happening is that they accounted for the majority, well, not wouldn't say maybe not the majority, but a large percentage of index returns. And this is my own opinion. I think it's simply down to the fact there are too few good opportunities that investors can chase. And therefore, those 7 companies with the AI hype felt much safer than other opportunities out there. And even, and if you're expecting bond yields going down at some point, reversing at some point, then those stocks look like even better bet. So I think it's down to too few opportunities that people are chasing, and those companies look really safe. With the AI hype as well on the tailwind, people start thinking they can go up. And the growth stocks actually plummeted when the bond yields went up, and a lot of them still haven't recovered to the all-time highs. I think the Magnificent Seven have reached their all-time highs and now surpassing it, whereas the likes of Cloudflare, Snowflake, I'm not sure about Zscaler, but a bunch of others are still kind of in the recovery mode. And I think their opportunities will come once the rate cuts are fully underway. Maybe not at the beginning, but when rates come down to below 3%, around 3%, or mid threes, we can see those stocks start to outperform because investors now have an increased appetite. The opportunity cost of chasing growth stocks is much lower because the treasuries yields would have dropped. And therefore, I think the opportunity for growth stocks will come maybe later in the year than the earlier part of the year and into 2025. And the final basket is financials. And financials actually have been quite ironic in a way, because if you think about interest rates as a product for banks take deposits and they lend money out to businesses, and they charge businesses interest rate on that. So interest rates are really pricing of their product. So the theory used to be that if interest rate goes up, they can lend money at a higher rate, they can enjoy a better return, and their stock price should go up. But what ended up happening is that you can see here, when bond yields got really high, their returns plummeted. And this is due to a couple of reasons. I think a bunch of them had invested their spare cash into US treasuries. So they had a lot of this, and the bond yields went up, bond prices went down, and the portfolio suffered. And that's exactly what happened with Silicon Valley Bank. They invested when the yields were at 2%, 2.5%, and now it's at 5%. They went bust. So actually, when bond yields come down, their portfolio will start looking better. And as long as the yields rate cuts are coming down, not because of a recession, I think the financial stocks can start outperforming again. And the reason I caveat is because if the recession actually comes at some point, then a lot of loans will get defaulted, which is actually also not good on the bank performance. And also the banks will go through high stress testing, etc. They have to set aside more capital for the regulatory requirement, then they can lend out. So I think it really depends on the rationale for rate cuts. If the Fed is just doing it precautionally to balance the risk of inflation, then I think the banks, the financials can actually outperform. So that's it. I've spoken for strict. Yeah. So any questions?
Yeah.
That's fantastic, Yimin. Thank you so much. There's a lot of material covered there, which again, you see people all over uh, the internet claiming to be experts on, and they're not. And you've stitched it all together really, really clearly for us. So thank you. Questions, folks. So a number of ways you can ask them. If you want to turn your mic on, you can shout into the system. You can post them in the questions function here in the webinar platform, or you can use the chat box in the webinar platform. So anyone have any live questions now, have at it. If not, if you think of them afterwards, then we'll post this all on YouTube, and you can use the YouTube comments field to fire questions there. I have a question from Ross. Ross, go for it.
Yeah, hi Alex, how you meet? I was wondering if you could give a quick dot plot 101. When you were talking about the dot plot, I wasn't quite getting it, and I've heard of it and seen it, and could you just do the basics of the basics?
Yeah, sure. Yeah, that's no problem at all. So so in the major meetings that I mentioned, I think I mentioned them. Okay, fine. They'll go cover back now. But in March, June, September, and December, usually the Fed will make an interest rate decision, but also release a document called the Summary of Economic Projections, in which they would talk about what they think about GDP and GDP interest rates and inflation for the next 2 or 3 years. And the dot plot is released alongside this document. And what is basically every participant, whether voting or non-voting, so this is why you see more than 12 dots, will make an assessment on where they think the interest rate will be, the Fed funds rate will be at the end of each year. So last year, everyone thought it would be between 5.25 and 5.5. For 2024, this is very scattered, but the key is where the median dot is. And the median dot is at 4.5% to 5.75%. So what this means is that the rate is currently here. People, the FOMC members see 325 basis point cuts in the next year, and then they see in 2025 the median dot. I can't eyeball this. It's either here or here. We'll have another 4% rate cut in 2025. And in the longer term, we'll settle down around 2.5%, which is perceived to be the neutral rate that for the economy. Does that make sense?
Oh, it does. Thank you so much.
Yeah,
And
no problem. And the
and
reason
great presentation. Thank you.
Thank you. Thank you very much. And the reason I've compared those two together is that on the left, this is where the bond market, the Fed Fund futures market is showing. The market is suggesting we'll go just below 4% by the year end, whereas the Fed, the FOMC members think was going to be, just above 4.5%. So there's a 50 basis point or two rate cut gap between what they expect and the market expects.
Got it. Thanks for demystifying that.
That's great. Thank you.
I'm glad it helped. Thank you.
A question from Prasad. Go for it, Prasad.
Yes, hi. Thank you for the presentation. Great presentation, great data. My question was just follow up on what you just mentioned, like the market is pricing in 6 cuts, but Fed said 3 cuts, right?
Yeah.
So
Yeah.
two questions if the Fed comes out and saying, it'll be too much to do 6 cuts, it's too risky and all that. Equities, I am guessing, will take a beating. Is that it? That is one. And second question is what are your feelings about the data that we've seen so far in terms of where the Fed would kind of end up doing it? Is it going to be 3 cuts, or is it actually going to be closer to 6 cuts?
Okay. Yeah. So I think on the first point, so the first question is around what would the market do if the Fed comes out and say we're going to stick to our guts and say we're going to cut 3 times this year. So in the hypothetical scenario, and Powell said we're not cutting anytime soon, and we don't see a cut, more than 3 cuts this year, the market will have to reprice and the Fed fund futures basically will go up. The yields will go up, and the yields will go up to remove those cut projections for this year. But the problem is that Powell doesn't really like to do that. He doesn't like to go too far ahead and try to predict what's going to happen in the year. And what he's been trying to do is always never get back into a corner. Always give himself and the FOMC some optionality around what they can do. And he's always saying, no, we're going to take everything meeting by meeting and evaluate through the incoming data. So I think the furthest he can go is that, we will seriously consider a rate cut in March for next year. It will be among the discussion, but he's not going to confirm it. But what normally happens is that ahead of the meeting, the Fed also hates surprises. So among all that ambiguity I just mentioned, they also hate immediate surprises. So the market is not going to really be pricing a 50% chance for that much longer. At some point in March, between now and March, someone from the Fed is going to say something to the effect of that we think we're already past the peak. We can now normalize towards the neutral rate, and the market will get the hint and price in the March cut. Or someone is going to say, we don't see cuts anytime soon, and the bond market will remove this and push everything out slightly further down. So this is always really fluid situation. Is the market, was pricing 7 cuts 2 weeks ago. Now it's pricing 5 cuts. It could go back down to 3, of course, but it's very, very dynamic. It's really hard to predict what's going to happen later in the year, where the market will be at, even for Powell.
So why is the market pricing in 6 cuts? Sorry to interrupt. Yeah, 6 cuts when Fed said 3. Why? Like, what are the things that the market is thinking that's causing them to think that Fed is like bullshitting and they're actually going to cut 6 times? What are some reasons?
So I think the market. So there are the key components that I covered in this webinar, which is how tight is the labor market? Can it withstand a higher rates for longer, or is the unemployment rate going up? Where is the inflation headed? Is coming down really nicely. And where is the GDP? Are we going to have a hard landing or soft landing if the Fed stays too long? And at the moment, all those signals. So from my perspective, I think these signals are quite contradictory right now. And I think there is a chance the inflation can come back. But the reason the market takes comfort in having 6 or 7 cuts is really because PCE the annualized 3 to 6 month figures is below 2% now. So effectively, the market thinks the Fed is done already. Like the Fed's job is done. And if we stay long, and what we need to normalize to, and the real interest rate, which is I can't remember where we are. I think the real interest rate at the moment is too high. So the core PCE is 2.9%, and we have an interest rate of 5.5%. We're having a real interest rate of 2.5%. When the neutral rate should be around 1%, right? So the market thinks, well, we need to get towards this, or we're going to have a recession. So if we get towards 1% from 2.5% real interest rate, that's 6 cuts of 25 basis points. So the market has priced it pretty much to perfection at the moment. Yeah. Does that make sense? So it's all those different factors the market is trying to look forward to and predict from theoretical perspective, incoming data and future data. They're anticipating that they come to this conclusion. They're not always right. Sometimes really hot data come in, like today we have really hot job openings data. If on Friday non-farm payroll goes to 500k jobs added, the market will probably recalibrate and say, oh my God, it's too hot. We might have to reprice to only 3 cuts or 4 cuts this year instead of 6. Yeah.
God. Well, so what are your thoughts on like what will happen in March? Will they cut rates in March or stay put?
So when before December, I actually thought Powell is going to stick to his guns and say we're not cutting anytime soon. But I think he pivoted a little bit in December, which is why market rallied. And so if you asked me this question before December, I would have said, oh yeah, I think 6 cuts is too aggressive, and March is a bit is too close. But having seen Powell changing his stance in December and having the PCE data coming in really neatly in a downward trend, especially the annualized rate I thought about, I actually think there's a very good chance that March we will see the first cut. And also, if you think about the fact that later this year we're going to have election, and if the Fed doesn't want to do anything around these dates, they can always front load their cuts from March onwards and then start skipping from November onwards to not interfere with the election. So the Fed can get tactical around it. So I wouldn't be complacent and say, oh, we won't have a March cut. I do think it's a very realistic option. I think without the nuance of the election year, without the pivot we saw from Powell before, I might not have said this, but where we are now, I think there's a very good chance, yeah.
Yeah, I'm going to introduce
Thank
you
you very much.
Prasad, great questions. Thank you, Ross. Great questions. Thank you, Richard, earlier. Great questions. Thank you, Yimin. Once again, a fantastic job today, making a very complicated subject very clear for all of us. Very much appreciated. So, folks, thanks for attending today. We'll post all of this on YouTube within the next couple of hours once it all upscales. And if you have questions, points, comments, anything, post them as comments to the YouTube video. And Yimin or I, probably Yimin, realistically, we'll get back to you on those as soon as we can. If you'd like to read or listen to more of Yimin's work, take a look at one of our 2 subscription services, either Inner Circle, which you can find on our website, sestriancapitalresearch.com, and I'll post a link to that in YouTube, or Growth Investor Pro that we run on the Seeking Alpha service, and you can find that. Again, we'll post a link to that right on the video recording. Thanks everyone for attending today. Yimin, thanks again. Fantastic job, and speak to everyone soon. Thank you, Yimin.
Okay, thank you, Alex. Thank you, everyone.